In 2020, Wirecard, a German payments company once hailed as Europe's fintech success story, collapsed after it revealed that nearly 1.9 billion euros in cash didn't exist. But the accounting scandal hit a second, less obvious failure: policy paralysis in the face of mounting red flags. Months before the collapse, regulators had already tightened requirements for audit and disclosure standards following earlier whistleblower complaints. Despite this, Wirecard's internal compliance and finance teams failed to update internal policies, particularly those covering third-party risk management, audit committee escalations, and whistleblower protections. By the time the policies were revised, investigative journalists, not internal teams, had exposed the fraud. The fallout from the scandal was quick and terrible. Wirecard went bankrupt. Marcus Brown, the CEO, was arrested. The chief operating officer, Jan Marsalek, went into hiding. The company's offices were raided by the police, and stock value plummeted, leading to its insolvency and ultimate delisting from the DAX index. The scandal also triggered a widespread regulatory investigation into auditing and regulatory practices in Germany. This KRI, days elapsed for internal policy updates in response to regulatory changes, is a powerful window into organizational agility. How quickly does your company respond when new laws or enforcement actions are announced? A delay in policy updates often reveals fragmented compliance ownership across departments, bureaucratic approval pipelines, lack of integration between legal, compliance, and operational units, and weak risk sensing capabilities. In highly regulated industries like finance, pharma, energy, even a 30-day delay can lead to violations, fines, or erosion of regulatory goodwill. Regulators like the US Department of Justice, FCA, and ESMA, the European Securities and Markets Authority, are placing greater emphasis on real-time compliance. That's why this KRI is rapidly becoming a standard oversight matrix for boards and risk committees. As always, here's how to monitor and manage this KRI. Firstly, timestamp all policy updates with reference to the triggering regulation or notice. Then log regulatory events systematically. Track which internal policies were impacted, by whom, and when they were updated. Thirdly, set thresholds. For example, policies must be revised within 14 business days of regulatory change. Then automate alerts from key regulators, for example, SEC, FCA, GDPR authorities, directly into compliance workflows. And lastly, run simulations. Quarterly dry runs of policy change response can test agility across business units. After the Basel III reforms reshaped global banking regulations, JPMorgan didn't just react, they institutionalized agility. They built a regulatory change management office that tracks changes across jurisdictions and mandates immediate triage meetings for internal policy owners. The protocols include a 48-hour initial assessment window, a 7-day internal policy mapping target, and monthly dashboards that report to the board risk committee. Because of this, JPMorgan avoided regulatory missteps that hit smaller rivals and was consistently ranked as one of the most resilient post-crisis banks. A regulation delayed is not a regulation denied. Policy delayed, that's an operational gap, and sometimes a criminal one. In a fast regulatory world, agility isn't just a strength, it's a survival trait. Crack this KRI, audit it regularly, and don't let your policies be caught napping when the law changes. Please share these insights with your teams and networks. Stay sharp, carry on auditing.